Well, I've just come across what is another, believe it or not, another ticking time bomb as it relates to the private credit, private equity structures in the United States. And I have an article I just saw today from Bloomberg. It's a $17 trillion problem for public pension funds in the United States that have invested their retirees' retirement, okay, into these alternative assets, right? So when you hear in the context of pension funds increasing their alternatives allocation, it typically refers to both private equity and private credit. I've been sharing a lot of the private credit stories in the last couple of weeks on the channel, and how basically investors are running for the doors, demanding redemption, their money back because they're getting spooked because these lofty future expected returns and valuations have no basis at all in reality, and they're blowing up. So private equity is a little bit different from private credit. Let me give you the distinction. Private equity is when the pension takes a stake directly in a company. The lockup period is longer, usually 10 to 12 years. There's a higher risk, but of course, you're bargaining for a higher return upon the exit, okay, down the road. Whereas private credit, either the pension is directly making loans or they're doing it through intermediary, let's say fund managers, right, to companies. The maturity dates are normally 3 to 7 years. Supposedly, there's a less or a reduced risk over private equity. And the returns, of course, come from your interest and fees. But we've been seeing what's happening with private credit and all this massive push into the AI infrastructure development, into distressed debt vehicles, which are, as I've been sharing, blowing up. I did a story a few days ago. I didn't even understand the scope of the pension exposure. I'm going to share that with you right now. It's massive. But about how that there would be staggering losses because of pension funds and life insurance companies committing massive monies to these alternative assets. So this one today out of Bloomberg, I'll share with you before I jump into the story. As always, humbly ask, if you're not subscribed to the channel, please subscribe so we can keep growing the community. I do welcome all of you and appreciate you watching. So out of Bloomberg, a quiet Wall Street force fueled $17 trillion alternatives boom. A small circle of investment consultants played a central role in the multi-trillion-dollar push into private markets, steering U.S. pension funds towards private equity, real estate, and hedge funds, according to a new study. It says portfolios moved because consultants encouraged pensions to chase higher returns in the alternatives. Okay, well, that means higher risks of failure, higher risk of these pension funds not receiving anything back, okay, going from 100% to zero. From 10% of total investments at the start of the century, listen to this, the share held in alternatives has tripled in the years since, underpinning a golden era for professional money managers who operate outside public exchanges. The impact has been sweeping. Rarely have so few, this is in the description today, I think it's a very impactful statement, rarely have so few influenced the retirement destinies of so many. Let me repeat that. Rarely have so few influenced the retirement destinies of so many. And what I mean is the tens of millions of retirees in this country that don't even understand that these pension funds are investing in these risky assets. Of course, they're the consultants, and it keeps getting concentrated on the top with a few big consultants. I'll share that with you in a second. It's part of the article. What the consultants are saying is really it's just us trying to get higher returns, better returns for our clients, right? The public pension funds. Some of you might say, well, this we can blame on on the Federal Reserve, right? And their continued, let's say, holding down of interest rates in this country, which has forced, if you want to call it that, investors of all types, private investors, pension funds, life insurance companies, to reach for yield. But whatever the cause is, this is what's happening. It says the impact, I just read you the quote. It's based upon anything other, and they're saying the consultants presumably have, made a good faith estimate of where the markets are headed. The consequences of being wrong, though, it says, would be far-reaching. If they're wrong, what the article says is they're potentially misallocating trillions of dollars of retirement money and paying billions of dollars in excessive fees. They're saying if their consultants are wrong, that's the error that the pension funds are making by going down this rabbit hole. Beginning in the early 2000s, consultants steadily raised their return forecasts for alternative assets between 2001 and 2021. The average consultant's expected alpha, how much more they thought alternatives would return on a risk-adjusted basis than public equities, rose by roughly 60 basis points according to the study. That's a significant gain in institutional finance, it says, where even a decimal point can move billions of dollars. In effect, it says consultants were advising pensions to buy more of something that looked like stocks, right? But still promising it would outperform stocks. Back to that whole reaching for yield. Is it greed? Is it trying to maximize profits? Is it just suicidal and extremely risky with monies that really don't belong to you? That's rhetorical. You guys can weigh in on that. The consulting business is easy to miss next to the swaggeresses of Wall Street's money management brigade, but its influence is vast and increasingly focused alternative investments. Those filings show that plans identify, listen to this is the concentration of these consultants that list Wilshire as their consultant, report allocating about 34% of assets to alternatives as of 2021. So if they're using Wilshire as their consultant, okay, Wilshire's putting 34% of the assets into these private credit, private equity structures. Clients of Maketa, M-E-K-T-A, and NEPC report roughly similar levels, about 32% and 33% respectively. The three firms together advise funds managing around $5 trillion. The pace at which pension funds have increased their allocation, says, far outstrips that of the broader investing universe. All right, so pension funds are taking the greater risk. They're increasingly occupying a greater share percentage of these investments. By 2021, U.S. public pensions were overweight alternatives to risky assets by 17 percentage points relative to the global market portfolio, a clear divergence from a neutral asset allocation stance. All right, think about that. Industry assets were about 17 trillion the end of 2023, rising to 29 trillion by 2029. Think about that. Massive monies at risk in illiquid, lockup vehicles where redemptions can be limited or changed, or the fund just never returns anything at all to the pensions. All right. Says the best predictor of how much a pension fund allocates to alternatives isn't funding ratio return target, it's the consultant it works with. All right, so it's again this self-fulfilling loop, right? Where the consultants, they get more clients in, they're making more in fees, and they're recommending these allocations, and they're kind of, let's say, pigeonholing massive amounts of pension funds into these preferred or recommended vehicles. Steve Foresti, Chief Investment Officer Emeritus at Wilshire, one of the big consultants, argued consultants weren't the dominant force, but helped guide the shift, particularly for plans that could manage illiquidity. He said the move into alternatives reflected more than forecast. It was a post-crisis world where cash returned zero. Again, the artificially suppressed interest rates Traditional portfolios fell short, and funds had little choice but to take on more risk, complexity, and illiquidity. Key words: more risk, complexity, and illiquidity, and we are starting now to see this play out in real time. Okay, the pensions are just going to be one of the casualties. Life insurance funds, private investors, other companies. So it says they describe how public pensions allocate risk in the real world, and that approach now, it says, according to this article, looks vulnerable, not just to market shifts, but to the slow motion revision of consultant expectations. And again, those guys always, I'm sure they've got multiple page disclaimers that say that they can't predict the future, they have no liability, they're just a consultant, right? And once they start shifting their mindset, okay, or their expectations, what was once, hey, this is the way to go, you're going to get outsized returns, it's going to be insane, because what I'm reading is these pension funds, especially in private equity, they don't have a right to reach in and grab this stuff back. Obviously, everything is funded differently, but it's not even as simple as a redemption. We know where that's going. We know the redemptions are the massive redemption claims now in some of these private credit vehicles are basically driving the fund managers, okay, or the general partners to basically just withdraw redemption rights and change the whole vehicle or merge it into a different vehicle. Wildly different estimates exist across academia and finance as to whether alternative assets provide superior returns, and the past is no guarantee of the future, right? So that's in the disclaimer language, I'm sure, that all these consultants are having the pension fund sign on behalf of their clients, right? Their retirees, okay? The big risk, and this is the last part, and I'll wrap it up. The big risk is what happens the big risk of what's happened is that a lot of pensions invested in these assets on the belief that they were going to deliver really high returns. And if those beliefs were overly optimistic, then that's going to hurt both funding and liquidity. And that's a very, very mild way of putting it. What are the, expectations right now for AI? And the build out of these data centers and how much money is going to be coming in from the data centers, and how we're seeing a real-time shift in market expectations, meaning to the downside. That it's not going to be what they're saying it was going to be, and that these trillions of dollars of loans that are out there floating around from life insurance companies, pension funds, et cetera, private wealth funds, are at risk. All right, went a little bit long today. That is kind of an add-on or an adjunct to my video from last week on the pension fund, because it's actually a much bigger problem than I even understood when I reported on it a few days ago. Thanks for watching. If you enjoyed the content, leave me a like on the video. Subscribe if you're not subscribed. Leave me your thoughts and comments. With that being said, I will talk to all of you soon. Bye.